Okay guys, welcome to this next trading example video, and in this example we're going to be covering an ES short on 2 time frames, multiple confluence, and we kept an eye on the previous close area, open area, as a price level to pay attention to. It coincided with a nice strong move away from an area price level that we wanted the market to get back up to take a short opportunity. Couple things to keep in mind for this example. Again, it's on multiple time frames. On the bigger time frame levels, 60-minute plus, the profit potential below for the market to retrace was very big, creating a nice risk to reward ratio for us. And then the area of interest, the price level that we were wanting to short at, was above the previous close open area. And again, as you know, for you guys that follow us and read the markets in a similar fashion, the previous close and the open are areas, are price levels that we pay attention to, because you can see price and the markets react off those levels in conjunction with the other factors that we look for. So let's get right into it. And for those of you that have the derivatives day trader course, if you need to brush up on anything, review anything for this particular example, check out sections 2 and 3. Okay, let's get right into it. So we have multiple time frames in this particular example. You can see the different charts that we have set up here. And so that's number 1 for us, is the multiple time frame confluence, looking for areas in price to line up to give us a better, higher probability trade setup. When you have the market moving to an area that shows up on more than one time frame, that's what we use as one of our signals, one of our criteria for trading opportunities. And in this example, we'll go over it. You can see that we had that there. We were looking for price to rally back up to the previous day close area and the open. Like I said, for a short, sellers came in and pushed prices down from that area previously. So you can see in here, prices dropped and closed below the previous day close, previous close in the open, and this level that we were looking at was above those levels. So the thought process was, if the market rallied back up to this area, since we have a lot of profit potential down below, down here, that this would be an ideal situation to define our risk and hop on board for a short. Again, the entry was above the previous day close. In the open area, it was on 2 bigger time frames that we look at. You have a 480-minute chart and a 60-minute chart, both confirming what we're looking for, what we're looking at. Even on the daily, you can see that we were in a bit of a correction. The market was weak for the past several trading sessions, past week and a half. We had bounced a little bit around this 2880 off of this area where the market moved up. But given where we were at, big round number, we saw weakness up here. We were expecting this to really be an opportunity to hop on board for a further move down in price. Basically thinking that this was going to be a shorter term top. We'd get a pullback and then a retracement back up to this area for an opportunity to hop on board short for a bigger move down. And that's what we were looking for. You can see that on the 60-minute, we had plenty of profit potential to the downside. You can see that in the green box. Really, it starts up here, because wherever your entry is going to be down to your target or price level that you'd look to get out, that creates the profit margin. And so the potential for a big risk to reward ratio was definitely there, increasing our chance of at least making some money on this trade. Now, not every trade we hits all of our targets. There's a lot of trades that we take that will hit the first couple targets and not the final target. There's a lot of time that we'll adjust our profit targets after the first and second ones are taken, just based on what the market is doing at that time. If it looks like the market wants to reverse and move higher, in this case, since we shorted, then it becomes more of a subjective thing where we can take price off, or we can take the trade off. We can move our stop to break even, or break even plus some. So it really just depends. But if we can get a setup where all of these factors are adding to the conviction of the trade, adding together to create the opportunity with the big profit potential, then there's a very high probability that we can make money on it. At least some money, and that's what we want to do. You always want to pay yourself as the market makes money available to you. You don't know how far the market will go. We don't know if the market is going to go all the way down to 28.74 from 28.92. But if we have our targets in place and we define our risk, then we simply let the market do what it's going to do. We have no control over what the market's going to do. We only have control over what we're going to do, and that's defining our risk, setting our profit targets, and leaving the trade alone. So that's what we did in here. And so finally, the potential buyers far below, creating a big risk to reward opportunity. And that's what we just talked about. This profit potential in here from 28.91 all the way down to 28.74 gives you that risk to reward. You're risking a few points to make, 4, 5, 6 times that for your final profit target. You're not going to have just that profit target. You're going to have multiple profit targets, or that's an ideal situation on how you would want to trade. You want to have multiple levels where you're going to be taking profit out. Because like I said, you don't know how far the market's going to go. You don't know for certain if it's going to go all the way down here. It could come down to 28.82 reverse and then stop you out. And you could be leaving money on the table, kind of thing. So you want to have a systematic way of taking profits, and also a way to define your risk to limit your losses. Right? So let's go through this again and highlight what we looked for. We have multiple time frames, daily, a 480, and a 60-minute. On the daily, we saw that we were in somewhat of a pullback overall. The market had bounced and looked like it wanted to get back up towards this high, this top in here, if you will, basically at 2,900 and above, created a short-term top. Once the market got back up to that area, we would look for a shorting opportunity. We got that on the 480 and the 60-minute chart. You can see that this level is clearly defined. Prices took out a high from right here, reversed, closed lower, paused, and closed even lower. So a nice big move away from this area, indicating that there were more sellers than buyers. And if we had a chance to hop on board via a retracement back up into this level, that's the opportunity we were looking for. And then finally, the big profit potential below, not only in this yellow box, but obviously it's going to be from up here, this 28.91 area, because that's where the entry would be. Big time frame, multiple time frame. You can see prices had not been back up to this area, this close to 2,900, after making this top, short-term top. And when it finally did, it took out a little swing high and got into an area where we have multiple time frame confluence. 1, 2. Prices tried to go up from this level, got rejected, closed lower, bounced, tried to move higher, could not, got rejected even lower, based out, and finally came back up. And this was the entry right in here, 28.94, 28.91, above in here is the opportunity we were looking for. The 28.94 actually tagged was the ultimate swing high, and then that level off of this was right below that. So it's within this area. It's close enough to this area. You throw that in conjunction with being above previous close, above the open. Looks like we have a weak market, a strong move away with lots of profit potential to the downside. And that's what creates this opportunity for us in this particular example. Right? You can see here on the day session only, a 5-minute chart, prices rallied up a little bit, got rejected, and then moved lower. Prices got rejected right in here off this 28.91, which was the 60-minute. You have the 480 right above that. And so you have confluence and conviction in a shorting opportunity with plenty of room to the downside. Hopefully that was helpful in this trading example. You guys got another idea of what we look for and how we use all of this criteria to add together to find our trading opportunities. Price action really dictates what we do and what we look for, and these other factors that we're taking into account just add to the conviction of our trade. And I keep saying that, and hopefully you guys understand that. That means how much confidence you have in a trade, and that's also going to dictate your position size as well. If you're very confident in a level, if you're very confident in an opportunity, you have, out of 8 possible criteria, you have 6 out of 8, then you're going to risk, your maximum amount. If you have 7 out of 8, you're going to risk your maximum amount. If you only have 4 out of 8 things being met in terms of your criteria that create a trading opportunity, then you may want to do half your position size or a quarter of your position size, a third of your position size, whatever it may be, whatever is part of your trading plan, right? But for us, again, we use all of these factors, we add them up, creates the confluence, creates the high conviction, and creates the trading opportunities that we're looking for. Not all of them work, obviously, but we limit our risk. We define our risk, we use stops, we have preset profit targets that we stick to. And so for us, it's really about the analysis, finding the opportunities, and then just letting the market do what it's going to do. So again, hopefully this was helpful for you guys. If you do have the Derivatives Day Trader course and you need to brush up on this section in anything that we talked about today, go back to sections 2 and 3. Other than that, we will see you in the next example.